In this topic, we'll unpack what money laundering and terrorist financing actually are, why criminals and terrorists rely on the financial system, and how their methods affect your institution. By the end, you'll recognize the core building blocks of these crimes and the risks they create. Money laundering is the process of cleaning dirty money. Criminals take profits from crime and try to break the link to the original offense. Their goals are to conceal where the money came from, use it without attracting attention, and then fund more crime. When that process works, illegal funds blend into the legitimate financial system. Think of money laundering as a tree that starts underground. The roots are the predicate offenses: fraud, corruption, tax evasion, drug trafficking, cybercrime, human trafficking, organized crime, sanctions evasion, and more. Without those underlying crimes, there's no dirty money to move. Each crime type leaves its own transaction patterns and red flags. As crimes cross borders, weak AML controls let this root system spread through multiple jurisdictions and into the legitimate economy. Now let's look at the classic journey dirty money takes to appear clean. First, in placement, criminals get illicit cash into the financial system, often by breaking it into smaller deposits or using cash-intensive businesses. Next comes layering: multiple transfers, intermediaries, and cross-border movements designed to break the audit trail and confuse investigators. Finally, in integration, the funds reappear as legitimate assets, such as investments or high-value goods, ready to be freely used. Modern money laundering keeps these stages, but the tools have evolved. Think of four forces. Digital velocity: online and fintech channels let criminals move and layer funds in minutes, not days. Global plumbing: cross-border payments and correspondent banking give easy access to multiple jurisdictions. Corporate obscurity: shells and complex structures hide the real owner. And decentralization: virtual assets and DeFi can weaken the link between identity and value. Your controls must map to each of these realities. Terrorist financing is defined by intention, not just by the source of funds. Money can be completely legitimate, like salaries or donations, or clearly criminal. Amounts are often surprisingly small, but the consequences are huge. These funds keep operations running: recruitment, training, travel, propaganda, and everyday expenses that make attacks possible. Terrorist financing often follows a many-to-one-to-many pattern. Multiple funding sources, some criminal and some apparently legitimate, are funneled into a central network. That network might be a front charity, a cash courier ring, or an informal value transfer system like Hawala. From there, funds are broken up again into numerous small, routine-looking payments, mainly for travel, safe houses, and living costs. That fragmentation makes behavioral context more important than transaction size alone. To quickly distinguish money laundering from terrorist financing, think in four dimensions. Origin: laundering always starts with dirty money. Terrorist financing can involve both clean and dirty funds. Objective: laundering seeks to hide the origin and legitimize wealth. Terrorist financing aims to enable an attack or operation. Transaction profile and life cycle: laundering tends to involve larger, circular flows, while terrorist financing is often smaller, fragmented, and linear, moving steadily toward an operational goal. In banking, money launderers rarely rely on a single obvious move. They combine patterns. Structuring uses many small deposits to dodge reporting thresholds. Trade-based laundering hides value in fake or inflated invoices. Velocity risks appear when money races through several accounts and countries in rapid succession. Correspondent relationships can be abused to conceal the true owner behind cross-border flows. Brokers and investment firms are attractive targets because markets generate huge volumes of legitimate trading. One tactic is to cycle funds through highly active accounts, creating complex transaction histories that obscure the original source. Others use wash trades, buying and selling the same securities between colluding parties to shift value or fabricate gains. Criminals also favor thinly traded stocks, where small price moves can move large value. Nominee accounts and offshore funds then help hide the real beneficial owners. Shell and front companies are classic laundering tools. A pure shell is just a legal wrapper. Registration, maybe a bank account, but no real staff or operations. A front company does trade but mixes illicit funds with genuine revenue so the dirty money looks like profit. Criminals then hide who really owns these entities through layers of companies, trusts, and nominees spread across multiple countries. They integrate funds using fake invoices, inflated contracts, and sham consulting deals to justify large circular payments. Payment and wallet apps have become prime channels for money mules. Criminals recruit people, often through fake jobs or romance schemes, to receive and pass on funds, breaking the audit trail. The risk increases when those payments move rapidly across borders through many small accounts and currencies. Fintech platforms can be abused for layering, using e-wallets and prepaid cards to obscure origin and ownership. These channels are truly dual use, highly convenient, but equally attractive to both launderers and terrorist financiers. Crypto and other virtual assets create new channels for both money laundering and terrorist financing. Criminals value this space because it combines global reach, speed, and partial anonymity. They can use privacy tools to hide trails, jump between blockchains, move value without banks, and exploit weakly regulated exchanges. As compliance professionals, the goal is to understand these behaviors clearly, not to fear the technology itself. Here's how a single criminal scheme can touch almost every part of the financial ecosystem. Illicit cash first enters through a money mule and a standard bank account. From there, funds move to an offshore shell company, then into crypto using an unregulated exchange, and finally back into a brokerage account as apparently clean investment capital. The key insight: no single sector can manage this alone. Effective AML-CFT depends on coordinated cross-sector controls and information sharing. Everything in this module connects to three core stakes. First, protecting the integrity of the financial system from illicit flows. Second, protecting your institution from legal, regulatory, and reputational collapse. And third, strengthening the human defense, where your judgment and vigilance ultimately make the difference.